Good morning. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Can you tell I'm caffeinated? Because I am. It's Monday, the 28th of November, Cyber Monday. I'm JD Durkin, as you could see from the blue box there on your screen. Opening bell rung moments ago here on the floor by Kraft Technologies. That's Kraft with a Q. Congratulations to them. The major indexes are in the red to kick off the trading week as markets are reacting to a lot. But top of mind, of course, here domestically is a big story abroad. That is ongoing civil disobedience, unrest in China that broke out over the weekend as that country doubles down on its strict zero COVID policies. The news dragging down the broader market as investors fear an ongoing global economic slowdown. Let's take a look for what's on tap for this morning's broadcast. We will talk retail as online Black Friday shopping sales soar past records to the moon, some would say. Plus, we'll discuss, is that a good thing or not? We'll discuss. Plus, we'll break down the impact of China lockdowns on the broader market as stocks do begin their pullback to kick off the week. And finally, we will talk Fed projections ahead of some notable speeches later on this week. Is Mr. Powell one of them? Spoiler alert, yes, he is. For more on those stories and so much more, let's now bring in our senior editor and markets correspondent, also our chief Thanksgiving correspondent, a title I just gave him moments ago, Martin Baccardax. Martin, the most important question I will ask you on this morning's show, how was your holiday?
It was fine, thank you, JD, for asking. It was reasonably relaxed. I did a little bit of work on the Friday after the Thanksgiving holiday, including a trip to a really significant shopping area in the northern section of Miami, a mall that's owned by Simon Properties. It's one of the biggest in the United States. I wanted to have a look at sort of, what kind of customer activity was there and everything else like that. So it was a busman's holiday to some degree, but enjoyable nonetheless.
And what did you see in terms of your observations there? It might be anecdotal, but I believe there's no better form of journalism than going out there to where the people actually are and observing yourself. Was it as busy as you'd expected? I mean, we've certainly seen the numbers. We'll get into them in just a second, but I'm curious what you saw in Miami.
Yeah, it was significantly busier than I had anticipated. The property itself is called Sawgrass Mills. It's basically just to the west of Fort Lauderdale, and as I say, it's one of the biggest in the country, run by Simon Properties, which is a group based in Indianapolis. The traffic was significant. There's no question about it. There were queues to get into stores. Some of the major brand names that I saw, Adidas, Nike, and others, had the really significant sort of customer flow in and out of the doors. People were carrying decent-sized bags. These are all micro observations, which, of course, tend to contribute to the macro picture. But lying in concert with the numbers that we're seeing, not only from online shopping, but from brick and mortar sales as well, it does seem like this weekend and the 4-day period, essentially from Thanksgiving till the close of business today, is going to be stronger than anticipated.
So I'd assume it's not a big surprise to you that according to Adobe, consumers spent a record $9.1 billion in online shopping during the pandemic. Seems like you got a bit of a taste to the brick and mortar side of things, but I can't imagine those numbers are very much of a surprise considering the sales, the opportunities for consumers to not necessarily go to an amazing mall like you were at and instead say, I'm going to wear my comfy sweats and sit on my couch and order what I want from my phone.
It's hard to draw any hard conclusions, I think, to some degree, isn't it, JD? Because we had, we'll probably get into this later in the program, but there were record numbers for sports viewing over the weekend, which would tend to suggest that people stayed at home. The record numbers that you allude to with respect to online shopping would suggest that people were also staying at home. But I think there's a hybrid sort of conclusion to some degree that we can look through, in the sense that there were probably a lot of purchases that were made on mobile phones, and the Adobe Analytics data seems to support that, which were then collected at the brick and mortar stores themselves, and then more shopping took place as a result of that. That's probably exactly what retailers would like to see, the sort of like draw you in online and then bring you to the shop in physical form so that you can buy some more things. So if that was the case, I think retailers will be very pleased with the outcome. But the numbers seem good. The traffic was good. The Transport Security Administration, actually, JD said a couple of hours ago that they screened 2.56 million passengers yesterday alone, and that's the highest total since 2019. So people are traveling, people are shopping, people are watching sport. In other words, JD, we are returning to normal levels of economic and commercial activity that we experienced prior to the pandemic, and that couldn't be better news for the biggest economy in the world.
You're right to your point about there being record viewership for sports games, which means a record number of Americans watch the Giants lose on Thanksgiving. Thanks for reminding me, Martin. I wanted to avoid it on the show today. Several retailers did report a bit of grim sales numbers ahead of the holiday season. That's true of Gap, that's true of Macy's, same for Target, just to name a few. Any reason for them to feel a little bit better today, given some of the numbers we've seen in just the last 5 days than maybe they even did a few weeks ago?
There was some hefty discounting along the way, JD, so I do wonder whether we will get a clear picture of exactly how everybody performed. Salesforce seems to indicate that more broadly, at least from an online perspective, discounting was about 30%. And that compares to numbers that we saw a couple of years ago, but was certainly a little bit south of the numbers that we saw last year. But nonetheless, reasonably heavy discounting against, of course, really elevated inflation. So I think much will depend on the level of inventory that retailers carried into the holiday season and indeed beyond, because they have to move some of that at the same time. So gathering kind of a consensus view as to how people performed will be difficult, and we probably won't have a good understanding of that until the last part of January.
You were alluding to it there. I wonder how much of this has been these companies trying to offload excess COVID-era inventory by the major retailers, right? A bit of a miscalculation at times to say, just because Americans or the average consumer wanted XYZ in the summer of 2020 does not mean that they want XYZ now. Is there, how much of a suggestion or strong degree of confidence is there to say that the Adidases, the Nikes of the world, the same companies you saw lines out the door for, Martin, are in part trying to meet consumers where they are now, but also trying to say, hey, you may really be interested in buying this stuff that we made years ago that no one has really wanted?
Well, there's certainly evidence that a significant number of retailers were caught on the back foot over the summertime because they overpurchased in the beginning part of the year under the assumption that once they had a window to get product from disrupted supply chains, they put their arms around it very quickly and overpurchased. So as a result, they ended up with an overhang in the summertime that many retailers did a decent job of shifting into the autumn. And that's maybe a big part of the reason why we saw October sales earlier than anticipated. Firstly, they wanted to capture some of the commercial strength of American consumers who still have a decent amount of pandemic savings, but also they wanted to get rid of that excess inventory overhang heading into the Black Friday period and indeed beyond, when they can get better margins. But again, we won't necessarily have a greater understanding of that until we hear fourth quarter numbers from all these guys in January. But Target is probably the company that we are most looking to with respect to its inability to shift inventory over the October quarter and whether or not it can reverse that trend heading into the start of next year.
I know we're going to have a little bit on this later on. I'm hoping you could preview a little bit of what's top of mind for you now that we've reached Cyber Monday components of the weekend. We had the Black Friday. We had notable sales numbers for Saturday and Sunday as well. That's to say, you may have people who have said last week, cool, I'm going to specifically wait for Monday, even if they are only conditioned to do so. So what stands out to you as the Cyber Monday shopping day kicks off in earnest?
Allegedly, it's going to be about 5.2% higher than last year, JD, in terms of overall dollar volume. But of course, that number will run south of headline inflation, which is in the high 7% range. So the number itself will be a record, but whether or not that's representing value to consumers is another story. But it is impressive nonetheless to see that people are prepared to spend over the whole of that holiday period. I don't think that Cyber Monday has the same sort of resonance that it might have had in the past, because essentially what we used to see previously was that people would do a great deal of sort of window shopping over the weekend, return to the office on Monday, and then try to buy the items that they saw at a deeper discount. We don't obviously have those same sort of working patterns now that we did prior to the pandemic, but nonetheless, people are still very value conscious. And as a result, will probably delay some of their spending, whether it's today or going into the early part of December and beyond, in order to make sure that they have the best possible result. So we'll see where that plays out. But nonetheless, Cyber Monday sales, if we can even describe it as such, are going to be at a record high of about, I think it is 11.2 billion.
Yeah, again, we'll hit that a little later on in the program. I do want to bring our attention now to China. These images were incredible. They were unprecedented. I mean, for a word that we've used a lot the last few years, it really does seem to apply here. These acts of civil disobedience over China's zero COVID policy, just incredible images, Martin. I think you'd agree the last 48 hours or so. What more did we learn since you and I last spoke? And what might investors want to keep in mind as that story and those images continue to unfold?
Yes, this one is going to be really difficult to parse because it's something that we really haven't experienced when it comes to the Chinese economy since 1989, and of course the protests there in Tiananmen Square. So we are seeing unrest that, to a large part, just hasn't been witnessed in a number of generations. But the numbers are small, of course, when you compare it to the overall population of the country. And we've seen a relatively rapid response from security authorities in China, particularly today, to make sure that those protests haven't extended into a third day. But the visual was enough, of course, to rattle global markets and to maybe push investors into some of the more defensive ends of the market. As a result, we saw a pullback in Treasury bond yields. Curiously, we didn't see that much of an appetite for the US dollar, but the yen, which tends to be the safe haven trade in the Asia region, certainly got a boost as a result of what was witnessed over the weekend. But China COVID infections are rising. They've had record numbers for a fifth consecutive day now, JD, of just over 40,000. So not only is COVID zero not working in terms of preventing the spread of infections, but it's certainly not working in terms of keeping the population happy or indeed even some measure of content at the same time. And that's a mix that could prove toxic for this administration.
Goldman, Citibank both raised their outlook specifically on China. So did Morgan Stanley. And I want to pull up that analyst note from the folks at Morgan Stanley. This was back in August. So again, not dealing with the current slate of information, but at the time, Martin, they wrote, as Beijing makes moves to strike a balance between economic growth and pandemic containment, Morgan Stanley research analysts believe China will reopen more broadly in the second half of 2022 and move away, says Morgan, from its COVID zero policy by the end of the year. Martin, was that premature, given that this was just a few months ago?
It certainly appears so. There wasn't any indication that China was going to move away from that prior to the Chinese Communist Party Congress in October. And then once that wrapped up and President Xi Jinping secured his third consecutive term, an unprecedented third consecutive term, it must be said, there was absolutely no indication that his signature economic and health policy was going to change in any way. There's been tweaking around the edge of it, but the foreign ministry, in a briefing this morning with reporters, essentially said, listen, we know that this is the best way to manage this situation in order to limit the number of fatalities and keep the economy ticking over. Now, you can argue with that until you're blue in the proverbial, but China does not appear ready to change any aspect of this apart from some tinkering around the edges. It is, of course, going to try and stimulate economic growth with sort of various policies. They've reduced the reserve requirement ratio for its banks. In other words, they allow the banks to lend a little bit more into the economy to try and entice growth. But the lingering effects of this are going to be seen not only in the fourth quarter, but indeed into 2023. And we're already looking at some of the weakest growth numbers in more than a decade. I just don't see that turning around anytime soon.
Is any hope of China changing its zero COVID policy further diminished by the fact that, as you talked about there a moment ago, you're talking about Xi Jinping, who has consolidated power? And I wonder to what degree even the moves that we've seen from him, even this year alone, helps chip away at any sense of optimism that this might soon change.
No, I mean, it's his signature policy, and he's simply not going to back away from it. Particularly not when it typically and most specifically won't be the case when he can quite rightly say that China's economy has weathered this in a way that has limited fatalities compared to some of its sort of Western counterparts. Again, that might not be the strongest argument, but from a life or death perspective, it certainly is. And I think to some degree, that is the message that will continue to echo from Beijing as it tries to justify this rather draconian policy.
I do want to ask you about West Texas Intermediate Crude. WTI here stateside is at now nearly a one-year low. You got to go back to late December of last year. This largely on the news in China. Why and what's the impact?
China's the biggest energy importer in the world, and the assumption, of course, being that if there is either a crackdown as a result of the protests or an elongated COVID zero policy, then manufacturing is going to be hit as a result. And that, of course, is going to elicit weakened demand for energy components, oil in particular, not only this month, but going forward. So you're seeing a pullback in prices as a result of that. There's also discussion at the weekend of a cap on Russian crude prices that could probably be somewhere around the $70 per barrel mark. That probably won't limit Russia's ability to pump crude, but at the same time, it will at least abate some of the revenues that it's taking in as a result of the sale of it. And of course, that would probably be the fine balance that the EU and the G7 are trying to strike. So it does seem that we will have consistent output and not necessarily the same kind of demand equation going into the start of the year. And that's what's pulling not only oil prices down, but gasoline prices as well. I think 354 was the national average I saw this morning, JD, from the AAA website.
Yes, that's a good perspective, because people will certainly remember earlier this year all of the huge bevy of headlines they saw with regards to rising gas prices. They probably saw and experienced it themselves, and I wanted to just give a little bit more context and perspective to how that story is being impacted by the headline this morning, so thank you there. I do want to ask you want to talk a little Fed? Yeah, of course you do. We always like talking about the Fed here on the show. New York Fed President John Williams is expected to speak again today. I know we'll hear from Jay Powell later in the week. I assume they will not tell us about their Thanksgiving dinners. What can we expect?
Well, Powell's speech on Wednesday at the Brookings Institute is probably going to be the most interesting, because it's going to focus for the most part on the job market, but it will also come a day ahead of a really key inflation reading for the month of October. Essentially, the Fed will look at its preferred inflation gauge, the PCE price index, to get a sort of measure of where they're seeing inflationary pressures and where they expect them to go in November and indeed beyond. And of course, you'll remember last week we had minutes from the early November Fed policy meeting where they raised interest rates by 75 basis points for the fourth consecutive time. But those minutes indicated that they're probably ready to dial back at least the size of those rates going forward as they monitor their impact on the world's largest economy. And they also are, of course, aware of the dislocation it could cause in financial markets if they were to keep up that pace. Now, an important caveat to all that is that the terminal Fed funds rate, i.e. the level that rates will probably rise to as a result of all these hikes, has remained unchanged, and that's probably between 5 and 5.25%. But if we were to get a de-escalation in inflation rates into the end of the year and indeed beyond, that number could change. So we'll get some clues as to what Mr. Powell is thinking when he speaks on Wednesday. But the biggest component of how the market will view that will be the PCE inflation data on Thursday and indeed the November jobs report on Friday.
Because I had a bond market question, but actually let's pivot there, since I think that's the nice way to take the conversation with regards to an eye to the future here for the next few days. You mentioned PCE on Thursday. We also still will have some pretty important companies, arguably in terms of earnings on Thursday, including Dollar General and Kroger. We will get ADP employment data Wednesday, and of course the big number Friday morning at 8:30, the November jobs number. How important will some of those outside of PCE, which you just talked about, be important to gauge? And are there any other data points you're expecting over the next few days, Martin, that you think someone watching right now might want to keep in mind?
Well, I think the two most important, JD, will be the Friday jobs data, as we know, but also the report on the JOLTS data on Wednesday. That's basically a report that indicates the number of unfilled positions that remain in the U.S. economy in any given month. So the JOLTS numbers that we'll see on Wednesday will indicate how many positions remain unfilled in the month of October. And it could be as high as 10.3 to 10.4 million, which is just a staggering amount when you consider the fact that the economy is, by large consensus, heading into recession. So there's absolutely a labor market riddle that seems to sit at the center of all these recession discussions. And the JOLTS numbers will go a long way to describing, or at least providing clues as to why that is the case. Now, the Friday jobs numbers themselves will be a bit more illustrative, because we'll understand not only the net new positions that were added to the economy over the month of November, but also what kind of wage increases were required to tempt people off the sidelines and into the labor market. You can assume that if there's 10.3 million unfilled positions, it's going to become increasingly expensive to bring them into the labor market. But what we're seeing actually, JD, is that wage increases are starting to slow. So that either says that people are becoming worried about employment prospects and want to get into the job market now, or that the JOLTS data itself is maybe inaccurate or not reflecting correctly the changes in working habits that we've seen as a result of the pandemic. So all of this is creating a lot of sort of noise and not enough signal around job market data. And therefore, that's why I think Fridays is going to be really, really interesting.
Yeah, for the month of September, those job openings for that month totaled about 10.7 million. To your point,
That's
they
right.
are a big number. We'll closely watch what happens there from the JOLTS data from the Bureau of Labor Statistics. I do want to ask you about the bond market. It seems like many investors have been turning to that, aside from waiting to see what happens with the Fed actions on inflation. What sort of movement there tells us, and anything that's top of mind for you? I don't know that all the time, every morning I ask you specifically bond market questions, but I wonder if there's a general movement or a point of interest that you would want to discuss that's important, as I see more and more about it in recent days.
Yeah, it'll be hard to parse it out from today's numbers, JD, because there was so much activity overnight as a result of the headlines in China. So you had a pullback in Treasury bond yields as prices go up, and of course prices went up because more investors around the world decided that they wanted to be in a safe haven asset whilst they got a better understanding of the picture in China. So therefore, what the bond market is telling us with respect to the U.S. economy is clouded a bit by those movements from international investors. But the more broader picture remains relatively similar. The difference between 2-year Treasury bond yields and 10-year Treasury bond yields sits at the steepest level since about the early 2000s. I think it's around 80 basis points now. And that's almost always a precursor for near-term recession. And we are seeing consensus from Wall Street analysts that this will happen sometime early next year. But to caveat all that is to look at the Atlanta Fed's GDP Now forecasting tool. It's an online instrument that anybody can take a look at any time, and it tries to reflect the current growth prospects of the economy as they sit today. The economy seems to be growing at a 4% plus clip, according to the Atlanta Fed's GDP Now tool. So that is a really sharp contrast to what the bond market is expecting in the next 2 to 6 months. Maybe this is related to the puzzling labor picture. Maybe it's related to the fact that the Fed is running off its balance sheet of excess fixed income securities. The bond market has to take those down, and it's getting dislocated as a result. It's very difficult to know what the true answer is. But I have not, at least in my career, recall a time when the difference between what the bond market is telling us and what the data on the ground seems to indicate has been so different. This is really a remarkable situation at the moment.
Before we pivot to rapid fire, Martin, anything else that's top of mind for you on either the markets or the week ahead?
The markets, I think more generally, JD, are probably going to begin their pivot away from what the Fed is going to do and more to what companies are going to do in the coming quarter and indeed beyond. I was struck when I was reading over the weekend. I had known this figure, of course, that prior to reading it last night, but it sort of put it into stark perspective when I did so. Fourth quarter earnings are probably going to decline by about 5.4%. When compared to the same period last year. That's once you strip away the energy sector, which you, of course, must do because of the volatile nature of it. So we'll get collective S&P 500 earnings of about 455 million, but they will be negative compared to last year. And that's the first time the market has experienced that really since the pandemic, which is now a little bit more than 2 years ago. So this will be an interesting test for stocks heading into next year. Again, once they hopefully soon neutralize the Fed rate path. When they do that and focus more on earnings, the picture might be a bit more grim.
All right, time now for our rapid fire section, and we will talk about something we've talked about before, but with a specific eye on one of the biggest companies, if not the biggest company impacted. Number one, what is China's COVID crisis doing to Apple's iPhone supply? Foxconn front and center. Martin, what do we know?
Yeah, it's going to hit it pretty hard. The estimation now is that iPhone 14, at least the high-end models, the production from that factory in central China could be hit by as many as 6 million units as a result of the disruption. And it's important to remember that these disruptions all largely predated what we saw over the weekend in terms of protests in Shanghai and Beijing. Workers at this Foxconn factory have been sort of demonstrating against working conditions, against pay, and against broader COVID restrictions for a number of weeks now. And it's been a slow drip of bad news for Apple's supply chain as a result. But the numbers we're seeing, 6 million on the iPhone 14, will have an impact. There's no question about it for the holiday quarter sales for Apple. They'll probably recapture it again in 2023 because demand hasn't changed. It's merely going to be an issue of supply. But nonetheless, this will trickle down to some of the electronics retailers. And there's no question it's going to be a headline sales impact for Apple. And that's probably why you've seen, I think the stock is off about 6.5%, JD, over the past month as a result of the reporting that ourselves and others have done on this.
Yeah, it is currently down, at least at the start of this trading session, 1.47%. We'll follow it very closely. Next up is Biogen's Alzheimer's trial in trouble. Number 2, Martin.
This is a difficult one to report because it's such a sad story. A 65-year-old woman who was participating in the phase 3 trial reportedly has passed as a result of a brain hemorrhage. And that brain hemorrhage, JD, was associated with proteins that the Alzheimer's drug itself was designed to target. So not only is it bad news from a company perspective, but it's horrific news from a human perspective. And as a result, there's all sorts of questions now about the efficacy of the drug and what the phase 3 trial data will bring when it is published later this week. And of course, Alzheimer's has been a troubling disease across the medical space for a number of decades now. There's only a few treatments out there. This was meant to be a new, developing, and reasonably successful one. The pretrial data that we saw in September was very promising. As a result, Biogen shares got a lift. But this reporting over the weekend and the sad death of the woman participating in the trial has knocked the stock off its perch and indeed raised even larger questions about the efficacy of the developing drug.
Yeah, a very serious story there. We'll follow that one closely as well. Okay, number 3 here, third and final NFL recap. Who won big this weekend? Week 12, I can't believe it's already here.
Fox, I think, to be perfectly honest, JT. You know, they had that Thanksgiving game, as you alluded to, between the Giants and the Cowboys. I think the number I saw was 44 million viewers. And that's a regular season record for an NFL broadcast and really quite something. Of course, you had marquee names at probably the best time of the day for the matchup. But I thought that was fascinating. Fox followed it up, of course, with the Friday football match between England and the United States, which I sadly had to listen to on radio as opposed to watch. But that was a record of 19 million viewers. And if I'm not wrong, JD, I think it was the most watched sporting event in American history that wasn't an NFL game, which is really quite something and says a lot for the popularity of the sport. And then over the weekend, there was also the Ohio State-Michigan football game, which had the biggest in-season television rating since, I think, 2011. So a big weekend for sports, but Fox, I'd say, comes out to be the winner with those 2 big broadcasts on Thursday and Friday.
Yeah, and more later in the week. Are you ready for the big group showdowns tomorrow? I believe you've got England, Wales, and of course you've got US, Iran tomorrow afternoon.
They're going to be just fascinating to watch. I don't know how viewers know or how much viewers know about the history, but back in 1982, West Germany played Austria in a game where essentially one needed to win and one only needed to.
Martin, I lost your audio for a second. Martin, you got me?
I do, JD. Do you have me?
There we go. Yes, I got you. You're giving us a great historical context.
So West Germany and Australia basically were accused of fixing the match because they knew the result that each of them needed to go through in the group stage. And they played one of those boring football games in human history. So as a result, FIFA changed the rules and all matches that end group stage have to kick off at the same time. So there's no advantage as a result to seeing the result. And I think that will be really interesting to watch these parallel games tomorrow. I will confess I'm rooting for the US. I think they played a spirited game against England, even if at times they seemed a little bit disorganized. But they have incredible pace on the ball, particularly when they're attacking goal. And that's always great fun to watch. And of course, I'll be rooting for England, my boyhood team. They will probably get the result they need against Wales. And it would be great to see both go through.
It absolutely would, and we'll be talking about it and breaking it down all week, as well as the important market stuff as well. We have fun here as well. The great Martin Baccardax, happy Monday to kick off the week, and thanks for being here as always, man.
Thanks, JD.
You got it. That's going to do it, folks, for the Market Open here from the floor of the NYSE. Stick with the Street for more on these and all of the major market stories that matter to you, and we will see you tomorrow.